Everyone is celebrating right now. Wall Street finally surrendered to Bitcoin. You can now buy a $500,000 house without selling your crypto. You can even put digital assets directly into your 401k. The media is calling this a massive win for financial freedom. But they are dead wrong. This isn't adoption. This is a trap, a meticulously coordinated $48 trillion trap, while you are distracted by zero down payment mortgages and shiny new retirement funds. Wall Street asset managers are quietly rewriting federal law. They have engineered a system to extract billions in hidden fees. And worst of all, if the market crashes, they are entirely protected. But you could lose your house. You could lose your entire crypto portfolio. And then the IRS will hand you a massive tax bill for the privilege. Here is the terrifying truth about the new Bitcoin mortgage and the dark reality of what is really happening to your retirement. Section 1. The origin of the misconception. To understand this trap, we have to look at the bait. For years, the federal government absolutely hated cryptocurrency. The Department of Labor literally threatened companies who offered it. They warned that crypto would destroy American retirement accounts. But then the script flipped overnight. In August 2025, a massive executive order came down from the top. Suddenly, the government wanted alternative assets in your 401k. They ordered the Department of Labor to back off entirely. They paved the way for private equity and Bitcoin in your retirement. Almost immediately, the housing market joined the party. The Federal Housing Finance Agency made a shocking, unprecedented move. They ordered Fannie Mae to accept cryptocurrency as legitimate mortgage reserves. And Wall Street was waiting with open arms to capitalize. Better Home and Finance teamed up with Coinbase. They launched the nation's first crypto-backed conforming mortgage. The pitch they are selling sounds absolutely incredible. You pledge your Bitcoin or USDC as collateral. You get the cash for your down payment instantly. You never actually have to sell your crypto. This means you dodge massive, devastating capital gains taxes. If your Bitcoin doubles in value, you keep all the upside. You get the house, and you keep your digital gold. It feels like the ultimate victory for decentralized finance. It feels like Wall Street finally admitted defeat and surrendered. The general public ate this mainstream narrative right up. Millions of younger investors are desperate to buy homes today. About 41% of families lack traditional down payment cash, but many of them hold significant wealth on the blockchain. This product was custom-built to target their exact pain point. But Wall Street does not do favors for retail investors. Every single feature of this new system has a massive hidden cost, and the deeper you look at the mechanics, the more terrifying it gets. Section 2. The Hot Take Exposé. Let us expose exactly how this token-backed mortgage actually works. You are not getting one simple, straightforward home loan. You are being engineered into a highly complex dual debt structure. Better Home and Finance gives you the primary fiat mortgage, but your Bitcoin secures a completely separate private loan. That private loan provides the fiat cash for your down payment. Because your collateral is Bitcoin, the lender takes on extreme risk. To offset that massive risk, they charge you a premium. Your combined interest rate is half to 1.5% higher. Over a 30-year mortgage, that costs you tens of thousands of dollars. But the real catch is the no-margin call anomaly. In traditional finance, if your collateral crashes, you get a margin call. The bank forces you to deposit more cash immediately to cover it. If you cannot pay, they liquidate your assets without hesitation. Astonishingly, the Better and Coinbase mortgage completely forbids margin calls. If Bitcoin drops by 80%, your mortgage does not change. You are not forced to top up your account at all. The media reported this as a massive revolutionary consumer protection. They claimed it shields you from the brutal reality of crypto volatility. But think about this situation logically for just a second. Why would a private lender willingly absorb that much risk? Why would they let your collateral vanish without any consequence? The answer is horrifyingly simple. They are not protecting you from anything. They are banking on the fact that you will eventually fail. They isolated the individual borrower from the daily price swings, but they transferred that catastrophic risk into the broader financial system. And they built a hidden trapdoor for when things go wrong. Because while you do not face margin calls, you face something worse. A brutal mechanism that triggers when you miss a fiat payment. But before we reveal that nightmare, we need to look at your 401k. Section 3, expanding the trap, the 401k fee machine. The crypto mortgage is only half of the Wall Street trap. The other half is aimed directly at your life savings. Right now, there is $48 trillion locked in American retirement accounts. Wall Street asset managers are desperate to get their hands on it. Traditional institutional investors are finally wising up to their games. Massive state pensions are rejecting high-fee private equity funds. They realize that passive index funds perform better and are far cheaper. This created a massive liquidity crisis for alternative asset managers. They needed a new source of dumb money to extract fees from. Enter the August 2025 executive order from the White House. Wall Street lobbied aggressively for this exact regulatory shift. They needed the government to kill the ERISA fiduciary protections. For decades, ERISA terrified corporate human resources departments. If an employer offered a risky, high-fee fund, they got sued massively. But the new Department of Labor rules created calibrated safe harbors. This means employers are now legally immune from participant lawsuits. They can offer private equity and digital assets entirely without fear. This allowed Wall Street to unleash the ultimate fee machine. They are building complex collective investment trusts right now. They are quietly sliding these into your target date retirement funds. Imagine a worker named Sarah who wants more crypto exposure. She moves her money into a new alternative alpha fund. Her old index fund charged a microscopic 0.04% fee. The new alternative fund charges a staggering 2.5% base fee. That does not even include the underlying performance fees they take. Over 10 years, that structural drag will devour her principal investment. Wall Street extracts guaranteed quarterly revenue streams from her account. Sarah takes on all the illiquidity and catastrophic market risk entirely. This is a generational wealth transfer disguised as financial innovation. But the financial elite are playing an even more dangerous game overall. Section 4, the subprime shadow. The greed driving these new products is creating massive systemic risk. We have seen this exact movie before, and it ends in total disaster. FHFA Director Bill Pult forced Fannie Mae to accept crypto reserves. This effectively forces the U.S. taxpayer to implicitly underwrite Bitcoin. They are pretending that highly volatile crypto is a stable, reliable asset. Let us look at the terrifying macroeconomic ripple effects of this. What happens when a severe crypto crash aligns with an economic recession? Borrowers will inevitably default on their primary fiat mortgages. The private lenders who funded the down payments will panic. They will try to liquidate the locked Bitcoin collateral immediately. But they will be dumping those assets into an already crashed market. They will absorb massive, irrecoverable losses across the board. If these concentrated losses trigger the insolvency of mortgage originators, the financial contagion will spread upward directly to Fannie Mae. By explicitly sanctioning these assets as valid reserves, we are doomed. The government is actively recreating the 2008 subprime mortgage crisis today. But this time, it is built on unregulated, hyper-volatile digital tokens. Top economists and lawmakers have desperately sounded the alarm. Senator Elizabeth Warren sent a scathing letter demanding immediate answers, but the administrative state pushed the dangerous rules through anyway. They ignored the safety and soundness of the U.S. housing market. They prioritized the profit margins of Wall Street asset managers. The entire system is now resting on a highly unstable foundation, and the people who will suffer the absolute most are retail borrowers, because Wall Street always ensures they get paid first, and they have built a uniquely punitive trap for anyone who defaults. It is a trap that destroys your credit, your assets, and your taxes. This brings us to the most terrifying part of this entire scheme. Section 5, the double liquidation tax bomb. Let us look at a real-world nightmare scenario to see the danger. Meet Marcus, a 40-year-old mid-level manager trying to build wealth. He uses the Better and Coinbase program to buy his dream home. He aggressively pledges $80,000 of his Bitcoin for the down payment. He accepts the higher interest rate premium without a second thought. 2 years later, a severe macroeconomic recession hits the entire country. Marcus unfortunately loses his job and his primary source of income. Simultaneously, the cryptocurrency market experiences a brutal, punishing winter. The value of his locked collateral crashes from $80,000 to $30,000. True to the contract, Marcus does not face a margin call, but his income has vanished and he misses 2 fiat mortgage payments. On day 61 of his delinquency, the trap springs shut permanently. The contract's liquidation clause is automatically and ruthlessly triggered. Better and Coinbase systemically liquidate his remaining Bitcoin collateral. They sell his crypto at the absolute bottom of the market. They do this to recoup the outstanding balance of the down payment. Most consumers assume foreclosure simply ruins your credit score for years. But under the crypto-backed mortgage model, the tax code is entirely unforgiving. When the lender liquidates Marcus's crypto collateral, it is a sale. The IRS legally classifies this forced liquidation as a taxable disposition. Let us say Marcus bought that Bitcoin years ago for mere pennies. The forced liquidation instantly triggers a massive capital gains tax event. Marcus has just lost his home to foreclosure. He has lost his entire digital portfolio to forced liquidation. And now the IRS hands him a massive tax bill for the gains. He is financially decimated from 3 separate sides simultaneously. Furthermore, the interest he paid on the loan is strictly non-deductible. He gets absolutely zero tax relief for his immense financial suffering. Wall Street gets their money back, but Marcus is utterly destroyed. This is the hidden reality of bridging crypto with traditional finance, which reveals the ultimate glaring hypocrisy of this entire flawed system. Section 6, the hypocrisy of TradFi-DeFi integration. Cryptocurrency was born out of the ashes of the 2008 financial crisis. It was explicitly designed to bypass traditional centralized banking systems entirely. It was meant to destroy fiat currency manipulation and government oversight completely. Yet the token-backed mortgage forces decentralized finance to bend the knee. You are literally submitting your Bitcoin to Fannie Mae for approval. You are conforming to the highly regulated U.S. fiat mortgage framework. To use this product, you must completely surrender your private keys. You must lock your foundational wealth inside Coinbase custody indefinitely. Coinbase is a publicly traded, highly centralized, government-regulated corporate exchange. If Coinbase suffers a catastrophic internal solvency event, you are trapped. If they face a massive cyber hack, your collateral is gone forever. If the government orders a regulatory seizure, your wealth is frozen entirely. The legal status of your locked collateral would plunge into utter chaos. Millions of dollars in Fannie Mae mortgages would be completely unresolvable. This product does not replace traditional finance with decentralized finance at all. It completely subordinates the blockchain to the archaic centralized mortgage machine. It destroys the core utility and freedom of cryptocurrency in the process. Wall Street took a revolutionary technology and turned it into basic collateral. They used it to extract higher interest rates from retail borrowers aggressively. They used it to justify exorbitant management fees in 401k retirement plans. They hijacked the populist appeal of digital assets for pure corporate greed. They convinced the middle class that this was a massive historic victory. But in reality, it is just a new flavor of the same old control. The banks always win, and the retail investor always carries the risk. Section 7. Wall Street is not your friend. The integration of crypto into mortgages and 401 KOs is not actual freedom. It is a meticulously designed financial snare set for the middle class. You are paying a premium to risk a double liquidation tax bomb. You are paying massive fees to enrich Wall Street executives without recourse. The system is rigged to protect the lenders at your exact expense. Before you pledge your Bitcoin to buy a house, read the fine print. Before you allocate your retirement to alternative assets, check the fees closely. Do not let the media hype blind you to the catastrophic hidden risks. Wall Street is not your friend, and they do not want you to succeed. They just want access to your liquidity so they can siphon it.